And the bond market is starting to sniff this out. The yield on a 30-year U.S. Treasury today rose above 4.9%. We're at 4.92%. The yield on a 10-year is 4.69. So these are the highest yields that we've had since the Fed started cutting rates. In fact, you have to go back even further than that. By the way, oil prices are now above $74 a barrel. They've been consistently rising over the past several weeks, as are a lot of other commodity prices. This is an amazing thing. And I posted this chart on X. But if you look at the CRB index, commodity prices, today it's at a 14-year high, 14 years. And in the last 7 months, we're up over 28% in commodity prices. And that's in dollars. They're up more in euros. They're up more in Canadian dollars. Dollar's been strong. So commodity prices are surging all over the world, right? In Europe, they're up over 30%. Christine Lagarde had a Twitter or an X post. She had a little video of herself. She's head of the ECB. And she greeted everybody by saying, 2025 is going to be a great year. This is the year inflation is coming back down to 2%. I mean, what is she smoking? It's first of all, it's about 3% now, but it's headed in the other direction. Prices are surging all around the world. Yes, we had a pullback in commodity prices as the Fed was initially tightening, but that's reversed. And again, we've had strong commodity prices, even with a strong dollar. So imagine how much stronger they're going to be when the dollar weakens, which eventually it is going to turn down. And, this is despite oil. We're at a 14-year high. So oil has been a lot higher than $74 a barrel in the last 14 years. It's been well above 100. So oil is one of the bright spots in this dark cloud here of prices. Other commodity prices. Look at coffee prices, right? Look at sugar. Look at cocoa, right? And other grains are starting to move. Look at soybeans. Look at corn. All these food items. Everything is surging in price. At the same time, the Fed and the ECB, they're all saying, hey, we've won the inflation battle. We just want to make extra sure that we're down to 2%. They're not even close.
Peter Schiff rattled off the list in one breath. Bond yields, oil prices, coffee, sugar, everything is skyrocketing. Yet you're still calm enough to say, how does this affect me? Maybe you just haven't noticed the hole in your wallet yet. You might dismiss this as a passing breeze, but the fact that the yield on 30-year treasuries has topped 4.9% is already sounding the alarm. If governments have to roll over their debt at high interest rates, it eventually trickles down to households. It becomes harder and costlier for ordinary people to secure mortgages, auto loans, or even basic personal loans. While you're thinking, great, the central bank is cutting rates, if long-term rates climb, you're going to have a hard time. You'll be sweating more to keep up with the payments. Meanwhile, if you underestimate the surge in commodities, coffee, sugar, soy, corn, and so on, you'd be mistaken. These raw materials end up on supermarket shelves in various products. If one morning you're sipping coffee and wondering, why is coffee so expensive now? The answer is right there. Commodity prices are at a 14-year high. Yet central banks keep telling the tale that they've defeated inflation. Who's buying that? Some people might want to believe it, but once they see the money leaving their pocket, it's hard to ignore reality. European Central Bank President Christine Lagarde says that 2025 will be just fine. Sorry, but looking at the current situation, the word fine doesn't really fit. With commodities skyrocketing, saying relax will bring it down to 2% doesn't align with what's actually happening. As Schiff pointed out, if commodities soared with such a strong dollar, imagine what'll happen if the dollar weakens. Scary? Yes, at least to me. But acting like there's nothing to worry about isn't a solution, so that's the first half of the story. Rising rates, surging commodities, and central banks painting rosy pictures. Brace yourselves because the more striking details are coming in the second act where Schiff critiques the media and the strategic petroleum reserves.
And the bond market is starting to sniff this out. The yield on a 30-year U.S. Treasury today rose above 4.9%. We're at 4.92%. The yield on a 10-year is 4.69. So these are the highest yields that we've had since the Fed started cutting rates. In fact, you have to go back even further than that. But again, this does not surprise me. This is exactly what I was saying was going to happen even before the Fed started cutting. But I said that when the Fed did cut, but we are moving substantially higher. You know, mortgage rates now are back above 7% and rising. They're going to be above 8% pretty soon for a 30-year fixed rate mortgage. But they're back above 7. Credit card rates are what, 25%. They're going to keep going up. Now, we got more bad news. I mean, forget about the fact that the mainstream media is ignoring this boom in commodity prices. I mean, which is completely inconsistent with the story the Fed is trying to sell. How can they be telling us that inflation is going to come down when prices are soaring? And these commodities, these are input costs. So they're going to bleed in to producer prices and consumer prices, right? They're going to move first. And then you're going to see it going, up the chain. So these are leading indicators. So how could you ignore? The last time we started to see commodity prices surging like this, it was before inflation really ran away. And then in the face of it, the Fed was still claiming that inflation was transitory, even though commodity prices were showing that that wasn't the case. Well, that's happening again. Now they're saying that, inflation's gone and commodities are surging. They are the result of the inflation that is already there. The Fed never put out the entire time. And now you're seeing it in these commodity prices. You're going to see it more in oil. Again, one of the reasons that we didn't have a bigger move up in oil when Biden was president, he's still president for a few more weeks, was his politically motivated decision to raid the Strategic Petroleum Reserve. Imagine where oil prices would have gone or might be now had we never, let loose all that oil. I mean, we didn't have to drill, baby drill. We just tapped. We just sold the oil that we already had.
And now is the time to really open your eyes. Schiff says, no surprises here. He predicted that mortgage and credit card interest rates would increase when the Fed cuts its rates. Sounds like a joke, right? But this is the reality. Why? Because as long as inflation isn't tamed or the economy isn't balanced, interest rates will keep fluctuating in a spiral. Do you think it's normal for credit card rates to reach 25%? Of course not. But this abnormal normal is now part of our daily lives. Let's get to the media angle. Schiff is shouting that the media is ignoring the commodity boom. Indeed, you often see headlines like inflation is improving in the financial pages. But if soaring commodity prices are causing major cracks in producer costs, soon enough that shows up on supermarket shelves. Like an ever-growing snowball, this eventually chips away at the consumer's wallet. In short, if the producer price index is rising, the consumer price index will follow with a delay, miss that connection, and you'll be left scratching your head asking, why has everything gotten more expensive? Then there's the matter of the Strategic Petroleum Reserve. Schiff points out Biden drained it for political reasons, otherwise oil prices would be even higher. Think about it, spending your emergency savings just to bring prices down for a bit. If refilling that reserve later costs you double, don't be surprised. Once the reserves are depleted, the oil supply tightens again, prices shoot back up, and then you ask, why is gas going up again? So, what's the second act telling us? Loan interest rates are climbing, commodities are still on fire, despite the media saying everything's fine, and using the strategic reserves is just a temporary patch. Don't fool yourselves, things could get worse. Next comes the third act, where Schiff answers, how do we fix it? Though he doesn't offer a sweet remedy, it might be the realistic one.
As I said earlier, that in order to get much lower inflation, we have to have structural changes. Americans have to save a lot more and spend a lot less. But we already have an economy that's built on excess consumption. The GDP is powered by spending money. Well, if you save the money, then you can't spend it. And you have to save it to build the factories, right? If we're not going to get the Japanese savings, we got to generate our own. Well, we can't save and spend the same money. So in order to rebuild our manufacturing infrastructure, we have to have a severe recession in the process, because we have to stop spending money so that we can use it to make these investments. And so we have to make those changes. But again, those are not the changes that are coming, because those are changes that are going to result in a short-term decline in how we measure the economy. So things have to get worse before they can get better. So I still think that I've got this thing handicapped correctly, that we're going to see an explosion in the price of gold and silver. The dollar's share of global reserves hit a new low, and what's replacing it is gold. And the central banks, I'm sure, gold. And so, we should be doing it. Take advantage of the $50 special at Schiff Gold. But I think these gold mining stocks, which went way down last year as a result of a huge sell-off post-election, the markets have got this completely wrong when it comes to the outlook for gold company profits. We should be loading up on these gold mining stocks. We should be buying the emerging markets. The emerging markets are not going to suffer from the Trump tariffs. To the extent that the tariffs are imposed, it will end up being a relief. Remember, contrary to what Donald Trump claims, we're not propping up the world. The world is propping up us. We do need their products. What they don't need is our fiat currency. They have the ability to print their own money, right? We don't have the ability to make our own products. Printing money is easy. Just run it off the presses. You don't even have to run off a press. You just create it out of thin air, right? So any government can create currency. They don't need ours. But producing real goods, that requires real capital, real labor, real infrastructure, right? Real resources that we don't have. And so Trump has it backwards. The world supports us, not the other way around. And he's about to learn this lesson the hard way.
And now we've come to the most crucial part. Schiff says that to truly stamp out inflation, structural reforms are necessary. Spend less, save more, he advises. Sounds simple. Consume less, produce more, and practice sensible savings. But who will actually implement this? We're constantly pushed to shop with endless promotions to keep the consumer frenzy alive. For politicians, saying, let's invest in the real sector and endure some economic slowdown for a while is almost the same as losing an election. Who would dare? Let economic data dip in the short term? Never. So, these radical remedies mostly just collect dust on the shelf. Schiff also points out that as the dollar's status as a global reserve currency weakens, interest in gold and silver may rise. That should shake those who say, I'm holding dollars, I'm fine. If the dollar loses strength, your money's real purchasing power erodes. Metals like gold and silver have long been seen as safe havens. That's really all the experts mean when they say, keep some in your portfolio, watch out for it. Of course, it's no magic fix. In the end, you can't create wealth without actual production. Printing money is easy, producing goods is hard. Schiff says, it's the world propping us up, not the other way around. In other words, countries could pull the plug on a consumption-driven, import-dependent nation at any moment. Frightening? Yes, but it's the reality. So, what should we understand from all this? 1, if we want to bring inflation down, we have to accept painful reforms in the short term. Politically, it's a nightmare, but there's no other way. 2, shifting toward production and saving instead of relying on credit and consumption might slow growth temporarily, but it sets up a stronger economy in the long run. 3, on the matter of reserve currencies, the dollar isn't as untouchable as it used to be. Gold and silver, no absolute guarantee, but Schiff says they have huge potential. After hearing all this, are you still saying, oh, it'll be fine? I don't think you should. Your rent, grocery bills, and energy costs are directly affected by these so-called theoretical issues. I hope my words have given you a bit of a wake-up call. Don't close your eyes and assume everything's fine. Schiff's message is clear. As long as we have unstable monetary policies, weak production, and rampant consumption, inflation won't leave us alone. Whether you take this seriously is up to you. See you in the next video. Until then, be mindful of your money, your spending, and your investments. Take care.